Hi everyone, Mark here at TSLA again. The market closed about an hour ago and I wanted to get a video out to you guys ASAP because I know it's a really big day. Could be a really big day tomorrow for basically everyone who's participating in the market, not just Tesla shareholders. Tomorrow is going to be the release of the CPI data for last month. It's going to come out at 8:30 a.m. Eastern time. So it gives you some time to hedge if you're that type of person. But before we talk about the action and hedging and other strategies, let's just look at the stock first. And we were seeing that Tesla has been pretty flattish today. It is at $269.79, which is only a 0.07% increase over yesterday. And let's zoom in on the price action here. Currently at the 1 hour, but I want to go to the minute and kind of show everyone what that action today really looked like, why it happened this way. So here is the opening. I'm going to zoom out a little bit. So we didn't really open much with a gap. A lot of the tech didn't here. And it had a pretty decent open in the morning where it came up around about 1%. And then it proceeded to kind of just sell off a little bit, pump up a little bit again, and just kind of sell off for the rest of the day until it got down to around $266. And at the end of the day, it found some buying. The rest of the market kind of acted similar if you're speaking of the major tickers and the indices themselves. And I actually want to look at the S&P 500 instead of looking at Tesla right now to give you a better understanding of this kind of price action, which happens sometimes before an event, especially a big economic release like an inflation report or a jobs report. Sometimes you hear about the data was leaked or something like that on Twitter when people see a pump that happens at the last couple minutes to last 30 minutes or so. And you see that here where there was a pretty strong consolidation in the indices for about 5 hours. So yeah, for about the last hour is the only time it really found a lot of buying. And it went up to a peak on the indices about 0.4% from this low right here. And people would wonder, like, so why? Like, why did it wait all day to go up? Like, if there is some decent outlook on inflation, and which is what a lot of people think, that tomorrow will be, because the comp is so easy, because it was so high in June of last year, that inflation reporting for June of this year could show a very, very big difference, a good difference, meaning that inflation over year would be really quite low. And a lot of estimations are around 3% for headline inflation, 4.9 to 5% for core. So if you see numbers something like 2.8, 2.9 for headline tomorrow, if you see core around 4.7 to 4.9, I think you generally can be pretty happy with that result. The Fed won't be, because Fed wants to see core down like at 2%. But that might really take a while because the economy has been resilient to the point that all these rate hike increases are not really getting people to stop buying things. I know that retail stocks and retail companies, they're hurting a little bit, but they're still afloat. And it's not like their stocks are not at all-time lows because they're not doing as horrible as one would think a company like that would be affected by, let's say, a recession. Like, everyone's looking for that recession, but it has yet to appear. So the conversation in this area would be, did the Fed pull it off? Did the Fed pull off a soft landing, meaning a landing that we can get through these rate hikes, we can get through inflation, and then we can start cutting without inducing a recession with any of those things? Now, typically what happens is the recession wouldn't start until rates are starting to be cut and until after rates have peaked. Now, currently, we do not believe rates have peaked. We believe that there will be 0.25 to 0.5% more rate hikes before the end of this year, and cuts won't happen until the end of next year at the soonest. But if recessions only happen after rates peak, and peaking won't happen until the end of the year, maybe the recession will happen later on in the year or early next year. Maybe the reason why people know that when a recession starts is after rate cuts have started. It's really because the rate cuts are starting because of an oncoming recession. That the Federal Reserve would be like, okay, the economy is slowing down way too much, way too fast. we need to cut rates. And usually the cutting of rates is a signal that it's desperate times. But maybe it won't be this time because we have survived thus far. It's been a year of really, really quick and strong rate hikes, and we're still here. We have companies that, like, we have all the car companies reporting decent quarterly sales for quarter two. So I want, it's really going to be interesting to see how inflation plays out tomorrow. But let's look at why there was kind of this there was a gap up, and then there was a consolidation, and there was a pump at the end of the day. The gap up was the reality was it's been pretty oversold over the last couple of days. A lot of the mega cap names have been selling off, and it's not like they did super excellent today. Like, they're very flat. But if all the mega cap companies, be it like a Microsoft, be it the Tesla, and be it Amazon or what have you, if they can be relatively flat and the other names could do better because people believe inflation is coming down at a quick rate, you don't want to necessarily be in the mega cap stocks. They can be flat and the rest of the market can pump, and you'll see a really good performance just because of the smaller names coming through. Now, what does it mean, the other smaller names? Well, it's really small cap companies. A really good gauge of how small cap companies perform is using the Russell 2000 ETF, which is the IWM, which really tracks very small companies, and some of them, like, notoriously are the regional banks. But these are the smaller cap companies who have been lagging the mega cap tech for the past 6 months, essentially. Ever since really the beginning of this year, mega caps have outperformed, I would say, by the biggest gap in history compared to the smaller medium cap companies. The reason for that is because Apple and Microsoft, they are a safe haven when money is tight, like, meaning when money is too expensive to procure. If you're a small company, if you're a mid-cap company, you are basically working off financing to get to your daily, everyday, expenses. Okay, you need cheap money to succeed if you are new. All these other companies that are worth trillions of dollars, like, they can survive because they are established companies with billions and billions of dollars in cash. They are not reliant on going to the bank and being, hey, I need more money, or going to your VC guy. A lot of venture capitalists have not been giving money out at all because, of course, a lot of the companies that were being backed by venture last year were crypto companies. Crypto hasn't worked out. But when they needed money, you would go to your VC guy. You'd go to SVB or something like that, Silicon Valley Bank. You'd go to a bank to get money. But you aren't able to do that anymore because the rates are so high. Even if they wanted to give you the money, these small mid-cap companies, what are they going to do? Pay 10% on a loan just to get through the day? They might as well go bankrupt. And that's why we've seen an uptick around 65% year over year of bankruptcies this year alone. So that the bankruptcies have really been affected, and also business credit is not very attractive right now because people think that there is this recession coming. I'm not saying it's not coming, but they thought that this recession is coming. And if you look at like ETFs like HYG, which is attracts business bonds, corporate bonds. I'm sorry. So corporate bonds have been really depressed, meaning that the rates are really high because people fear that these companies could go bankrupt. So they need to offer really high percentages on the bonds when they raise money. So all of this has led to a depressed performance in the small cap companies. But as you see here, small cap did pretty great today, and it has been doing pretty good over the last couple weeks, I would say. The chart won't be that telling, but but you can see how it flagged, right? If we were to draw this little consolidation, and I'm sorry to bore you, but this is pretty important to understand why Tesla's been forming the way it has. You could honestly say that it's broken out. If you want to draw this into a flag, let's say, instead of a range, let's draw just some trend lines, and then you could see how. There we go. You can see how it really broke out. Bear with me. This is being very problematic. There you go. There you go. Okay, so you can see how it's breaking out. Like, this is a typical bull flag, and this is that is the pole, and this is the flag, and it's out. So this is why a lot of people think that okay, maybe the worst is over, okay, and we can get back into these other vulnerable names because the economy is going to be good enough that in the near future they'll be able to get free, not free, but cheaper money, perhaps, and that's a possibility. And this is telltale of why the mega caps are flat or red today. It's because they've already run up. Like, let's look at Tesla again. Let's zoom out. Let's look at the daily. Tesla's already run up. It's already had a decent year. So do you think people are going to use Tesla to find outperformance in the market? If you are requiring beta, if you need to really make up losses for your fund over the last year, because the thing about it is most hedge funds this year have not made a lot of money. They've had this really skewed idea that bonds and energy would be the plays. So they need to catch up. They need to have, by the end of this year, they need to find performance somewhere. And being short and being long energy has not been working out for them. So Tesla's had a 180% move, let's say, this year. But small caps and mid caps have gone nowhere. And so don't feel bad that Tesla hasn't performed today. The reality is it's because people, they know that if the market is back, let's say it is back, let's say this is a real bull market, you're not going to double your money in Tesla right now as fast as you could double your money in, let's say, real estate related stocks. Let's look at Redfin today. Redfin had a 24% move today. It's up even more after hours. So if I was to draw it from the opening, the gap and to the after hours performance, this is 25.76% on a company that helps people sell homes. And you're telling yourself, okay, I don't understand. Everyone's been telling me that the real estate market's going to crash. It's supposed to be crashing already. It's been over a year and it hasn't crashed yet. I don't understand. Like, interest rates to get a 30-year mortgage is 7.8%. How is the real estate stock performing at 26%? My Tesla shares are up 0.07%. But the reality is because these stocks have gone nowhere. Because no one wanted to put money into small caps because they would be the ones that would go bankrupt first. They would be the ones that would zero out your equity. If a company goes bankrupt, your stock goes to zero. They have no chance. They don't have a lifeline. Because who wants to give them money? They couldn't get money in the first place, and no one would want to give them money in the second place. So you're saying to yourself, is this an outlier? What about Zillow? Everyone knows Zillow. Look at this gap up from Zillow. Zillow had a 10% day probably, right? I would say at the peak it had 11.25, and by the close it was around 9.2% up. Everyone knows what Zillow is. You go to Zillow, look for homes for rent or for purchase, and people can list their homes and sell by owner on them. And you're saying to yourself, what's going on here? Like, is this the most shorted tech company in the world? It's possible. It's possible. What about let's not look at tech companies. Let's look at the things that the company that make homes themselves. Here is XHB, which is Home Building Associated Names. Look at this chart and look at this recovery. If you're telling me that the real estate market is dead, that we're going into a recession, well, XHB says otherwise. These home builders and associated companies that provide services and appliances and stuff like that, this thing is up 58% from the lows. It's coming back to its all-time high. It's beat its peak in 2021. It's only a couple percent away from equaling an all-time high. And look at the day it's had. An ETF like this is up 1.3%. So there's two ways to look at why smaller companies go up. And it is because what CNBC will tell you is that, because they are very shorted. So any slight movement up kind of makes people want to close out their shorts. How do you close out your short? How do you cover? You buy stock at whatever the price is at that moment, and you're good to go. You might experience a loss because you probably shorted at a lower price and you have to buy at a higher price to cover. And you lose money on that difference, right? At the same time, that kind of builds. So every time someone covers, someone else is wondering if they should cover as well. And they're going to have to buy at a slightly higher price. And this kind of cascades into this never-ending pump, right? Never-ending pump. And so it would look like, okay, you see a gap up and you see people try to short it. So let's say this is what the action will look like on something that's pretty heavily shorted. And I'm not sure if Redfin is, but small caps in general are pretty shorted. Even JP Morgan's been recommending shorting IWM, which is the Russell 2000 again, as a way to hedge if the market was to go down. So you had this gap up and a sell off. So this sell off is people that are literally trying to short this stock down. They're trying to short it. They're probably short already, and they want to create more shorting pressure that kind of drives the price down. And then they realize, oh, the rest of the market it keeps going, and people are using this opportunity at this lower price point to cover. They're like, okay, this will at least give me a point to cover where it's only up. It was only up at that point at 2%, and you can just cover and you're good to go. And they realize, okay, oh no, this thing still keeps going up. The market's going up. Okay, the market's flat and this thing is still going up. What's going on? It could be driven by short covering, but the reality is it also could be driven by the front running of, oh, I think inflation is going to be really low tomorrow. And then thusly, small companies can eventually get cheap money again. So small caps are coming on as a kind of, they're going to front run an event, especially an economic event, because people want to be positioned in something pretty volatile if the market is going to go up tomorrow. And the reason for that is, like I said before, a lot of people were not positioned for 6 months of rallying in these bigger tech names. They missed out. And if you have clients that you're responsible to and you're managing their money and you're telling yourself, I miss Tesla. I miss Tesla's 180%. How can you face them? How can you face them as a person, a professional trader or a professional money manager or a fund manager? How do you face your clients who missed out on what could have been, and I'm not saying this is going to go up forever, but what could have been a buying opportunity of a lifetime? And this is not being facetious. This is not being sarcastic. A buying opportunity of a lifetime. How do you face them? So you end the year, flat? You end the year down because you're long oil or XLE? No, you're going to position yourself into something that's going to be very volatile and something that's already depressed, and which is going to be small cap names. Let's zoom out on the small cap names so you can better understand what we're dealing with here. And as you can see, you could, if you're, I don't know, if you're a wick-off pattern type of person, or if you are or if you're just a day trader, like maybe you're not looking out on the bigger picture of what IWM is looking like, but this is the daily chart, and it's gone nowhere for, if you want to talk about, if you remember Tesla's consolidation from spring, like this box right here, let's measure that box so we can describe to people what that brutal 84-day ranging that happened earlier this year before we pumped from all this AI stuff. I wouldn't say it's just AI stuff, but there's really good sentiment around, people adopting NECS for Tesla. But looking at IWM, like look at this range. Let's say this is the consolidation range, and we still have yet to break out. This is 448 days of not making a new high, not really making a new low. There's no new high, there's no new low, but it's found interest in this area where it is bouncing. So let me go back to the rectangle and draw that out for you. So this is obvious, right? It's finding interest in this area and it's bouncing. It's not making new lows. It's not making new highs. So if you're a person who's not positioned, this is where you find yourself in. This is where you find your performance. That you maybe can get back to highs. Like this high on an ETF is 28%. If you look at the S&P 500, are you going to get outperformance on the S&P 500? Well, let's zoom out on the S&P 500 and see how far we are away from creating an all-time high. I haven't measured this, so I'm very curious myself. 8%. So it's not going to be S&P 500. What about NASDAQ? If I was looking at the QQQs, how many more percent to make an all-time high? 11%. So even with something that's really decent beta on NASDAQ, you're not going to get the possible performance on these bigger mega cap names. You're likely not. And not to mention what we talked about yesterday. What did we talk about yesterday? We talked about how the NASDAQ was rebalancing their index, which is why there's a lot of immediate weakness on Monday with the Apples of the world, the Microsoft and our Tesla. And so there's a lot of unknown. What's going to happen with Tesla when the NASDAQ 100 rebalances? We don't really know what weight it's going to be. Maybe it's going to max out at 4.5%, and it might not be changed. But as a person who's trading this market, you want to de-risk yourself, right? So if you're de-risking yourself, you sell Tesla because you just don't know what's going to happen on Friday, and you won't know what's going to happen tomorrow on Wednesday for inflation. So there's a lot of event risk that's going to happen in the next 3 days. So don't be surprised by the weakness of Tesla. I told you a couple of days ago, this is not the name you want to be day trading. This is not the name you want to be trading. You just want to sell your calls against your shares if you have the stomach to do that. And like I mentioned, there's ways to risk your upside on the stock, lower that risk by doing a calendar spread. And that's what I've done for Redfin. I own Redfin, so this is why I track it. So it was a really big day for me. I only own 4 stocks. I own Palantir, Redfin, Tesla, and Nvidia, with Tesla making up like 90% of my holdings. I like Redfin because they're a good company, but what I do is I had a call sold at $15 a share, and I had that sold for next Friday. I bought calls for $15 a share that expire this Friday. So what happens? Even though this thing pumped up from $12.50 or something like that to $15, and I was saying to myself, what do I do now? Well, it's easy. I just sell both. So I would sell the call that's expiring this week and take that profit. I would buy the call back for next week, and then I would wait for an opportunity to sell a call again. So I bought back the 15, and I sold my 15 that expired this week. And when it got to, I would say somewhere around 15 and a half, I sold a $17 call for next week, and I bought a $17 call for this week. And it's just like the difference is somewhere a range of like per contract. It was like something like $30 difference. So, I feel really good about those types of trades. And I do the same thing with Tesla, figuring that next week we have earnings. So if I was to zoom out again, you see earnings here is on the after the ninth day after trading hours on the 19th of July. So I have a call sold to expire on Friday, July 21st, and I have a call I bought that expires at the end of this week. So why at the end of this week? Because I don't know what's going to happen with CPI. What if the whole market rallies over the next 3 days? What if Tesla rallies 10%? That would be quite problematic for me because the call I sold next week would be in the money or close to it. I have a 290 sold for next week, and I bought a 287.50, I think, for this Friday. And I buy it, and you don't have to buy the call at the same time you sell the call. What you're trying to do is trying to sell the call. When you sell a call, you want to sell it at a high, quote unquote. And whatever the high of the day could be, it could be whatever the high of the week, whatever time frame you're working with. When you sell calls, you kind of want to sell it when it's pretty green. And then when you buy a call as your hedge for any upside risk, you want to buy it when it's cheap. So when the stock is red, you might want to add a hedge for any upwards momentum that an event like tomorrow might bring to the market. Or what if the rebalancing on Friday isn't that big of a deal and the QQQs and the NASDAQ, runs, then you could be in trouble too if you sold a call on Tesla and Tesla goes up 6% in one day sometime within the next week. We don't know what that's going to be like. So having that kind of hedge for any upside would be pretty beneficial. I think a lot of people got burned on cover calls over the last couple months with Tesla because, they figured they saw they got a 10% move in a couple days and they wanted to protect themselves. And I understand exactly why. Looking at Tesla's action on the 1 hour, what does this show you? What I think it really shows us is that Tesla isn't making lows. So even though we almost fill the gap from our delivery pump, so this is our gap, this is relatively healthy to have some type of pullback. and there's understandable reasons why the stock sold off. We understand why. Now, fundamentally, like I said yesterday, nothing about the company necessarily has really changed. We could say going forward, if tomorrow's inflation number is very, very good, what does that mean for us? That maybe more customers for Tesla will come around because they can get loans that don't cost them an arm and a leg to buy a Tesla, and that would be a boon. Now, I understand that rates won't come down immediately, but you have to understand the market. The market is not waiting for something to happen, like a rate cut, and then it just zooms. Okay, yes, if there was a rate cut, the market will go up. But what would happen before that is you will see price action of people that are quote unquote smart money, understanding something might happen, and they're going to be pre-positioned for that move. Now you wonder sometimes, like, okay, so why did it go up, then went back down immediately? Like, you see that sometimes, and you might see that with certain CPI releases, maybe one tomorrow, that it'll go up and immediately go down. And some people say, oh, you got trapped. But the reality is, sure, maybe you got trapped, but the action is this. Over the course of the previous days, weeks, months, or years, people are positioning themselves for something to happen. And let's say there's a big move on the market when that thing finally happens, and they're out. They're trading. They're swing trading. They want out. They want their profit. And you'll see a kind of a cascade in pricing after the event has been realized. And the first person out, and here's the thing about the market. No matter what anyone tells you about patience in the market, patience is not a real thing. If you are a person who's just buying stock every month for your IRA, for your Roth IRA or whatever, and you're not really caring about the action, you can't say that you're having patience in the market. You're just buying and kind of not paying attention. For people that are buying and swing trading and they're like, you know what, I'm going to buy, I'm going to scale into a position and just be patient, it's going to work out. That doesn't work out for people all of last year. That did not work out for many, many people when it came to bonds. That did not work out for people this year when it came to oil. So patience is not necessarily a virtue in the market at all times. Sure, it can work out in some specific scenarios, but when it comes to trading, being the quickest to panic has been probably the most successful thing that they can do. What does that mean? It means that when you get to the point where you know that you've made decent money, you just get out, and you get out as quickly as possible. If you see that there's a possible turn to the economy, or if you believe that there's some news coming out for the stock that you're interested in, you just get out immediately, and you just take whatever you can get, and no one goes broke taking profits too early. I think everyone got rich in this world that trades stocks by getting out too early. No one got rich by getting out too late. That doesn't make any sense. So panicking as quickly as possible to get out of a name turns into the action you see on CPI days or CP or PCE days, where it's like, oh, we got a nice pump in the pre-market. Okay, so it's 8:31 a.m. The report's out. Inflation's good. It's down 0.1%. Perfect. I'm buying. And they want you to buy. They want that price to go up. Because once the market opens and liquidity starts coming in, the order book fills up for all their tickers, they're going to start selling. And they're going to sell it quick. They want to get out as quickly as possible. Now you can say to some, well, what if the market goes up another 1%? Well, the thing is, you don't know where this big money bought. You don't know at what price point they were getting in at. Maybe they had an amazing entry. Maybe they did. And you can probably see it through Tesla. Like when Tesla hit 277 right here, and this is 277, and it just started selling out for a couple of days, this is what happens. They see a decent number. They got a 177% rally from the lows, and let's say they entered, somewhere in, springtime. And they want to get out. They want to realize that profit. And they start selling, and they sell, and they sell, and they sell. And so you, as a Tesla fan and an Elon fan, and you love this stock, you don't understand why anyone would want to sell. But the reason why they sell is because they don't love the stock. They're trading it. And you see kind of this cascade in pricing. It was immediate. It was just like, okay, here's the open. It hits it and just sells immediately. That was the open. And just sell. It found a little buying and then proceeded to sell. Because you don't know, like for you, let's say you entered here when you had like, oh, this is really good. Like it gapped up and you feel good about the stock, you buy. And then the thing about it is they can sell anywhere from here down to here. They can sell. If you bought here and he's like, it doesn't make sense why they're selling. Well, maybe they bought it down here. And they need to get out and realize that profit because they don't know how much lower this is going to go. So this kind of creates that kind of cascade in pricing where the reverse happens when, like I was talking about short covering earlier, where it cascades upwards, where it just starts rallying really hard because people are covering, where people are trying to take profit. They're trying to get the best price for their shares. They want to get out, and they're going to get out fast. And that's why selling always looks so quick. Like all this takes much longer. All this buying and all this pumping, this takes a long time. And you're like, and then you see selling and it's just quick and it's quick and it's like this. This is all quick up here. This is quick selling because people are they're panicking quickly and they're getting out quickly. So it's not meant to scare you that when your beloved stock drops a lot and very quickly, because if you're just holding for the rest of your life or until retirement, maybe you actually appreciate when these price drops happen very quickly because you can just add and accumulate more shares at a slightly lower cost. But the overall structure is still okay. Like we still have a higher high. So we had 277 here, like I mentioned. And then we saw a 284 almost twice. Could have been a double top. And this could be a double top on a bigger time frame. We don't know. We really don't know. And it's really just going to be based off events. It's going to be based off earnings. It's going to be based off inflation. So this price action is just, of course, being heavily manipulated. This stock will range until earnings. I'm quite sure I would be super surprised to see this above 290. I'm not saying it can't happen. Even on a good CPI report. Okay, let's just look. Do you think this is continue to range even on a good CPI report? Well, this is the top of what I perceive the range to be. Now you tell me, perhaps we can get, 5% in one day. This is 7% to what I believe the upward range would be, which would be around $289. A 7% move. It's possible. It's possible within the next couple of days with really good information. But what could keep Tesla from performing and keep your covered call safe? What could keep Tesla performing is what I mentioned before, where the Russell 2000 is where you get the most outperformance. And that's why the Russell today was much more consistent. It stayed greener longer, and it was higher than the other indices, even the QQQs, the NASDAQ, because this is where people are going to find their beta. They're going to find their money here, if anything. Like, what about regional banks? KRE is a regional bank ETF and has been really depressed since the banking crisis in March. Do you think that you will have more performance from Tesla in the short term, in the next week, or the banks if inflation is lower? And the reality is most likely with the banks being so flat for so long, people are going to think, even if it's not true, that this is a good price. Now the market has stabilized. And they look at Tesla, and you hear it on CNBC all the time. This is overbought, egregiously overvalued. Stay away from this name. They're not making any money. So if you're a regular person, if you're a person who's in the Wall Street, maybe you're just really not looking at Tesla. Traders look at Tesla, but I doubt there's many people accumulating lots of Tesla in their funds. It's just really not a thing, which is why I recommended Rivian to people who like Tesla only for a short period of time, and it had like an 80% move. Fantastic, right? Rivian was red today. Not too surprising, because it had such a great run. And there has been a lot of press lately about how Rivian, even though it had this run, but they don't make any money. and so they fear that with this increased price per share, that management could sell shares to raise funds. And so what happens? People panic quickly and they get out. So that's a good sign for Tesla, because Rivian didn't drag down Tesla. Though Tesla is in the same sector as Rivian, Tesla didn't get dragged down by 4% like Rivian did. Rivian kind of recovered a little bit over the course of the day. It wasn't terrible. But overall, Tesla's in a good position for now. And as much as, we can look at the chart and the pattern, it's a higher high, it's a higher low. No new lows have been taken out, and obviously they haven't. If you look here, there's no new low coming in so far for months, for weeks. So that's good. But inflation is that's going to drive the whole market tomorrow. Now let's talk about hedging a little bit again. Now, you guys know I've been selling covered calls since basically around here about a month ago. I've always, for the past month, I've had calls sold against my shares the entire time. And I've always bought a call to hedge it, so it was pretty easy to manage that. But even if I didn't, I would be pretty comfortable looking at this chart, thinking that I didn't need to really hedge for upside risk, because even though it did move up a little bit, it's been pretty sideways over the past couple weeks. If we want to just let's measure this range that we're seeing here above the gap to the recent high and to today's close. This has been 33 trading days. Okay, I've always been mentioning that we're in a range for quite a long time. It's 33 days. Okay, not trading days. Maybe this is just 33 calendar days. So this is 33 calendar days. This is 144 hours of trading. It's gone up and down within an 18% range, which is, I would say, relatively tight for a month of trading for Tesla. And yeah, that this is burning theta. Like if you're wanting to day trade Tesla, this is not when you day trade Tesla. You don't day trade Tesla a couple of weeks before earnings, because it will not move in a way that is substantial. I mean, sometimes you would have Tesla move 4% in a day and you realize your calls only went up maybe 10, 20%. Because the way the volatility with Tesla is, like, it can come in the morning hot. The volatility on this individual ticker can be super high. And then as the price rallies, volatility just disappears and your calls become more and more worthless as the volatility disappears. Even if the price is increasing, it won't outpace the volatility crush all that much. So if you're day trading Tesla, I recommend that you really find good setups. If you're buying options, that is, find setups that you can scalp, meaning that you're not looking to like hold calls for 10 days. What you're wanting to do is hold a call or a put or something like that for the day. Like this area right here would have been a perfect, scalp right here. That was a 5% drop. That would have been perfect for a put. I had 2 puts over the weekend and a call sold against it, because it's always nice to have a call sold over a weekend due to theta being destroyed for 2.5, 3 days, because theta does go down theta gets destroyed even on weekends and all holidays. So if you're looking at Tesla 2, 3, 4 weeks, 5 weeks before earnings, you can say to yourself almost confidently, which is crazy, but you can look at the charts that it might not move enough to make trading worthwhile. And you might want to, if you're a day trader, you don't want to be trading this name necessarily unless you're buying a lot of time, meaning that when you're buying calls or puts, they're really far dated, maybe even past the earnings date. But Tesla's options are very expensive. And you'll be and waiting that long for something to work out, that would be quite an opportunity cost when there's other names like, your Zillow, for instance, that are moving big in big swings, and you don't have to worry about holding on to thousands of dollars of calls or puts and get destroyed with theta burn that whole time. If you're trading Tesla, I would say selling options is key. When you find yourself thinking that, we've now entered the typical consolidation for Tesla, and we can zoom out so we can remind people, if you haven't seen me talk about the ranges, Tesla gets into ranges where it consolidates. And you can even say this area is a consolidation, but I wanted to do it from when the price broke down. In this area, this was from January 26th until the earnings on the 19th of April. This was 84 days and a range of 26% up and down. It went really nowhere though. Like this is not a great swing trade. Consolidation here. This was from July to October of last year, and it was like a 19% range up and down, and this was just months of going nowhere. Really just going nowhere. What about this one? Here's another, I can draw this area here. This is another consolidation into another consolidation. So this was a really disappointing move. Yeah, you had a nice pump, and it wasn't all that substantial compared to what we had experienced this year so far. But this range, let's measure this out. In this consolidation was 20% up and down approximately, and a 57-day range or consolidation. It just, you'll find yourself in these situations. And so when do you, if you want to trade Tesla, if you want to buy calls, you really have to understand when you're entering a trend. Like over here, when Elon started selling Tesla shares to pay for Twitter's purchase, or at least have cash in case he needed it for Twitter's purchase, like when you saw this breakdown, that gap down, like, so what are you looking for? What kind of setup are you looking for? I think it's perfectly this. You had a gap down, and then you had a test into the gap, and it failed, and it came crashing down again. So it was a 3% gap down. You kind of found a base. You then actually gapped up here, got into the gap, and boom, sold off again. And that's kind of when you're establishing like, oh, maybe this will be the start of a downtrend. And start of an uptrend, oh, this is pretty obvious. This is a nice gap up, and it was a strong gap up on earnings. And you could say if that was a good reaction, yeah, maybe you can go long. But it wasn't, this was a move that it was something like 30%. And you have to understand, maybe that's all the move for yourself. Maybe getting 25 to 30%, you should be happy with that. It's hard to say though, because you can be like what happened this year, and then you go 177% for the year. But let's talk about what might happen tomorrow in CPI. So let me zoom in on the minute. So in the pre-market, it's going to be really volatile. Around 8:30 when it's released, it's going to go up and down possibly. And if it goes up, okay, you might see similar action to what you saw today. So if people feel good about the market and you see the market go up, something like it went up like 1%, and then kind of flagged a little bit and then sold off. Well, this right here, this is trying to get you out of your position. And it can happen the other way. What if the market sells off on the inflation? Well, it can continue selling, right? Eventually. But it might what it might want to do is get people out of their puts. Maybe like, let's say inflation is at consensus, meaning it's 0.3% and 5% on core. What if the market is green at open and with a gap up, and it wants to get people out of their puts? It's going to make them hurt a lot. But if it opens down, and because it's at consensus and it didn't beat consensus, let's say it gaps down and you open red, they want to get you out of your puts again. Then you're going. The first situation was getting out of your calls. So this situation is getting out of your puts. So it might pump maybe 0.5% from the gap down. So it'll gap down, maybe it'll pump about 0.5%, and then people are like, oh crap, I thought the market was going to sell on this news. Let me get out of my puts. You close your puts out, and then it sells off. And this was something a little bit more exaggerated, where it's like, okay, so we had a good feeling about the market this morning, and this was probably off the. And so people ask, like, why did we pump? Well, I think a lot of people are understanding inflation might be easing. A report came out recently, with the last day, that showed that used car prices are down considerably, and used car prices make up like a dozen percent factor in core inflation readings. So if used car prices are down considerably year over year, then that means possibly that core can be down more than we understand. So people felt really good about that, and the market kind of gapped up. And so they wanted you out of your calls. They would go gap up, and then it come back down immediately, which it did, up and down immediately, and then consolidated and made sure everyone was out of their calls. And then they entered here, right? And then they bought it up themselves. So they kind of double dip. They have their calls and they have the price going up, and you're out of your calls and you're out of your puts and you're not participating anymore. I mean, the whole goal, if you're a market maker, is to make people like you and me not participate. That we're scared out of our position. So what do you do? Like, what do you do when you see this action? It's like, this is just painful. Like, it's going nowhere. Like, you feel like, wow, I can't win either way, right? Because if you're trying to scalp this move, this is pointless, really. I personally think this is pointless to scalp. But, so what do you do? Well, you kind of have to think about when you're trading, the idea of a stop loss. I know there's jokes around that Carolyn girl who worked at FTX, and she's notoriously famous for saying she doesn't believe in stop losses. Well, I kind of don't believe in them as well, because you get this type of action. Now, where does this action come from first? Let's talk about why do we have this type of rangy action on an intraday basis. Well, the reason why we have this is because it's really the advent of 0 days to expiration options. So all the indices like the S&P 500, the QQQ, and of course the futures market, they all have options that expire every day. So every day you can buy an option and it'll expire the same day. What does that mean? Well, the volatility of an option that expires the same day is very, very high. So if you wanted to protect yourself against a sell-off, you can simply buy a very cheap 0 days to expiration option. And if the market sells off from that point 1, 2, 3%, you will increase. I mean, that call or put or whatever you bought, that option will increase by a factor of hundreds of percent. So if you have a position that's worth thousands of dollars, you can simply hedge it with a 1 0 day to expiration put, and that would probably cover your losses for the whole day, even if there was a tremendous sell-off, a la a Jackson Hole sell-off in August of last year. If we go back in time to August of last year, and it's Jackson Hole, and Jerome Powell is on stage and he tells everyone in the crowd and everyone on TV that we're all going to be hurting. Businesses are going to be hurting. Individuals are going to be hurting. The market sold off many percent over the next coming days. If there was 0 days to expiration options for SPY and QQQ, do you think that they would sell off that much? The market couldn't afford to pay out all those puts. If everyone just would have bought a 0 day to expiration put, it was over. There would be no sell-off. It would be like a 1% down and flat. And the next day, maybe a gap down 1%, so you can't buy a put. And that's how the action works. It wants the gap around, because that doesn't allow you to enter very good 0 day to expiration options. So the gap downs are beneficial for market makers sometimes because they need to have an edge. They lost an edge because everyone like you and me can just buy an option that expires today and we're covered. Whew. You're covered. Now, it doesn't exist on every ticker. Obviously, it doesn't exist on Tesla, but Tesla's a large part of the QQQ. It's a large part of the S&P 500. So you get affected by that. You can just buy a put on the SPY or the QQQ, and that could be a hedge for Tesla because Tesla makes up a good couple percentage points on that ETF. So that's why the action sometimes is laborious lately. It's so technically sideways. This is just, it goes nowhere and it goes up and down, up and down, up and down in a very tight range. And at the end of the day is when it breaks out, right? So you see this move at the end of the day within a period of 1997 bars. Why can't I see it? Why am I seeing this as hours? Well, anyways, within a couple minutes, we'll look at the time here. Within about an hour and a half. Within an hour and a half, it made 1.4%. Okay, so the market doesn't want you to have your move. And the whole kind of market went up in the same way. So it wasn't like Tesla was going up by itself. People that were buying the S&P 500 and QQQ at the end of the day were driving up all the stocks, all the holdings in those ETFs, and Tesla kind of goes along for the ride. So if you are fighting against 0 days expiration options, okay, as a market maker, you have to plan your move at the end of the day. And why is that? Why does the move happen at the end of the day? It's because by the end of the day, the options that you bought, if you bought a 0 days expiration, SPY put, or a call, around here in the morning, by the time it's, 3:30 right here, that thing is theta has destroyed the value of that. You could buy like a call for $50 here, and by the time it's 3:30, that thing might be worth $1, right? So their whole point is to destroy theta during the course of the day and not really give many moves for you to make money on, and then show their hand at the end of the day. And number one, what does that do? When they show their hand at the end of the day, they're actually helping themselves. If they can drive people to buy up the overall stock and overall index, they can enter the trade that they've been looking for. So if they want to be short for tomorrow, why not if you're the market maker, why not buy a bunch of calls at the end of the day, start buying shares yourself. Everyone drives up the price of the stock because maybe they're covering shorts or they're participating in what you're doing, which is end of day buying. And then you can enter puts here. You can sell everything here and you can buy puts for tomorrow, and they're much, much cheaper. So you made your profit up. You could possibly make profit down if it goes down, but you entered your position you wanted cheaper. And you can see it the other way where it might sell off towards the end of the day. And then you realize, oh, today's Thursday. Sometimes this happens on Thursday because Thursday will give you a 1 day to expiration option to the next day. So if it gaps up, you make money just immediately and bigly. So let's say it's Thursday on a week and it's selling off into the close. And you could buy, I don't know, a bunch of Coinbase options that expire the next day and make 700% in a second with very, very little investment because you sold all the shares to drive the price down at the end of the day. That means that all the options that are expiring today, they're not going to be as valuable, and people have to close with barely any profit, if anything at all. And then you can enter along or the opposite of whatever direction you're aiming for that day. So the next day you can go the opposite direction. You can go long if you sold it off the day before. So that's why it's really hard sometimes to day trade with the advent of 0 days to expiration options. So just be careful with that. So that's why Tesla has this type of action. It has that type of action because it is one of the most liquid names in the market. It is up there with SPY. It's up there with QQQ with the amount of people that are buying, the volume of people buying options and just in the shares themselves. There is so many people in Tesla because there's people like you and me who love Tesla. And so we're in it and providing a lot of liquidity, which is just the ability to get in and out of your positions and in a very efficient manner. Very efficient because there's so much interest. But yeah, so let's just be careful tomorrow. If there's a good CPI reading and the stocks gap up in the morning, just be careful for reversal. Just know that the reversal could be getting you out of your long position. All right. And it could be them selling their long positions as well. That forces the price to come down. But don't be surprised if you have a gap up in the morning, a sell off to take profit, and then continuing to pump up after it scared people out of their positions. Let's say it gaps down. It's very possible that the reason there was a gap down tomorrow is because it would mean that inflation reading was too hot, especially core. If that's the case, don't be surprised if it continues to sell off. You might, if it's gapping down because the data was so bad, you might not get an opportunity to get out at a better price. So if you're trading, you have to kind of scale out quickly. Not financial advice. That's what I would do if I was long, because you might not get the position that you need. Can you hedge against it? If you're long, yeah, you can hedge. So let's say you're long. Maybe your option expires on the 28th. So you're aiming for a post-earnings move, but you're realizing, oh no, the stock tomorrow is selling off. I was long. Well, what you can do is you can do a calendar spread immediately, or you buy a put that expires this week to cover your hedge, to cover and hedge your long that expires 2 weeks out. And you'll find that the volatility of the near-term option sometimes, and not all the time, can really cover losses on longer dated options or your shares, because the volatility is what really makes it valuable, right? If volatility goes up, which it will if it sells off, then puts will become more expensive. And maybe if you have a put already, it'll become more expensive just alone through volatility. And if you buy it, and the whole point for you is, you want to protect your downside. Could it be that the data looks bad and the market gaps down and it gets bought up? Kind of. If inflation is a little bit hotter, the thing is we don't understand the tolerance for what is too hot for the market. But you got to realize if the inflation reading is above consensus, meaning that it's too hot, you just got to be really careful with your longs. And if you're really heavy Tesla and you have a lot of shares, think about hedging immediately. That's not financial advice. It's what I would do. That if I was to see that the market opened and Tesla was down 1% already at the open, even if it was down 2%, 3%, it wouldn't hurt to get a cheap puts or a couple cheap puts that expire this Friday to cover yourself. It could happen. It could happen. But the reason why there is some positivity today is because a lot of traders think that inflation might have come down a lot. So I'm sorry to drag this out so long. I hope this was helpful in some way, guys. But yeah, that's it for me, from Mark from Tesla. I want to get this video up so you can watch it tonight. Thanks so much for listening. Bye.